Okay, so it's not exactly a secret. The US economy has crashed in 2020, whereas the US stock market, well, it did crash in February, but incredibly, it has rebounded shortly afterwards and now sits not just above where it was at the start of the year, but is at historic all time highs. That's right, despite everything going on, the US stock market has never been higher than it is today. So, what exactly is going on here? You probably have a few important questions. Number one, why is the stock market at all-time highs in the midst of such uncertainty? Number two, when could it potentially crash? And number three, what can you do to protect yourself in case this happens? So in this video, I'm going to show you my research as I've been trying to answer these three questions for my own investments and really for my own sanity. I'm not a financial advisor and this isn't financial advice. My only goal really is to share my research with you in the hopes that it can help you to make a more educated decision. Okay, so let's get straight into it. And we're going to talk first about the why. That way we can ask ourselves the question, do we see the reasons why continuing or are they coming to an end? And if we can do that, that should give us an indication of what could potentially happen. Okay, so unless you've been living under a rock for 2020, you obviously know what's going on, so there really isn't much point talking about the cause of the economic meltdown. Instead, let's look at this chart. This chart shows us the USA's GDP with each quarter compared to the previous. If you don't know what GDP is, it's basically a summary of what's going on in the economy. So this chart shows us that the US economy had been growing pretty steadily. That is until the first quarter or the first 3 months of 2020. Here we saw a drop compared to the previous 3 months of 5%. Not too extreme, but then again life in January and much of February was largely uninterrupted. After this, we saw a huge drop of nearly 35% compared to the previous 3 months. So if we turn our attention to the stock market, naturally, we're going to see that the first 3 months of the year weren't great, but they weren't too bad. And then the last 3 months, the 3 months that just came, will be a horrendous drop. Right? Well, not quite. The stock market performed well in the beginning of the year until mid-February, then a sharp crash followed, which bottomed out on March 23rd. After this, the market rebounded with incredible strength, and since then, it has gone on to climb above the value at the start of the year, and again, somehow above all-time highs. If you're a little bit confused by this, welcome to the club. With the economy tanking, why is the stock market acting as if nothing is going on? The first thing to consider is that the stock market and economy simply are not the same thing. The economy relates to the production and consumption of goods and services. So are you buying a new car? If you are, you're buying an item and that's positive for the economy. Are you going to restaurants? If you are, you're paying for a service and again, that's positive for the economy. The stock market, on the other hand, that's just the value of the companies in America. Specifically, when we talk about the US stock market, we're usually talking about the S&P 500, and that's a measure of just the 500 largest American companies. It doesn't take into account local businesses, and it isn't a measure of the amount of goods and services that people are buying. But I know what you're thinking. If I buy a car, let's say a Ford, well, Ford are one of America's 500 largest companies. So if I buy one of their cars, that means that Ford increased their revenue. If Ford are making more money, the company is worth more. If I go to my local restaurant, they might not be part of the top 500 companies, but me going there puts money into the hands of the restaurant owners. And I'm sure at some point soon, they're going to be going to a Starbucks or a McDonald's and they'll spend that money. So while the economy and the stock market are different things, of course they are closely linked. And generally speaking, the stock market will reflect the country's economy on a long enough time frame. However, the economy is focused on what's happening now, while the stock market is focused more on what's going to happen in the future. Remember, the price of any stock is simply what two people agree that it's worth. If somebody is really optimistic about the future of a company, they'll probably be willing to pay a decent amount, a decent price for that stock. So an argument could be made that investors in the stock market are just banking on the economy coming back strongly, and so they are happy to pay a price not based on what's happening today, but based on what they think is going to happen in the future. Okay, so this idea of looking forwards, it does kind of make sense, but I mean, come on, we're at all-time highs. Are you really telling me that you're as optimistic about the future when you look today as you were just at the start of the year? I don't think you'd find many people who would actually say yes to that. So let's go deeper about what's going on here. Quickly, before we do that, I'd just like to say this video took a while to research. So if you appreciate the time and effort that went into this, it would be great if you could just smash the like button for the YouTube algorithm. And if you're a regular viewer, heads up, there won't be any videos next week, but I'll be back the week after. Okay, so the next and perhaps most obvious reason is simply that the Fed, the USA's central bank, has publicly committed to doing whatever it takes to support the economy. And part of that involves dramatically lowering interest rates, printing huge sums of money, and even making a commitment to buy company bonds, which effectively means loaning money to companies to support them during this time. And look, I'm not going to debate about the right and wrong strategy. Honestly, I'm nowhere near smart enough to try to criticize the people who make these decisions that know so much more than me. Instead, I'm just going to highlight a few of the effects which have come from this. Imagine you were running a company and all of a sudden this craziness happened. You look at your balance sheet, which is kind of like a company's version of a bank account balance, and you realize that it's not looking too great. Now, you were planning on making lots of sales this year, so your bad balance wasn't such a problem. But now you know that that probably isn't going to happen anymore. But there is good news, because the Fed have said that they'll support your business by loaning you money. Best of all, it's a pretty cheap loan too. Well, of course, you're going to take the money, and hopefully that extra money in your account should tide you over until things return to at least some semblance of normal. Now, many companies have done exactly this, but the thing is, some of these companies have also decided they're still not feeling too comfortable, and so they've made some of their staff redundant as well in order to cut their costs. Now we can begin to see how the company might be okay with a cheap loan that they've received, and so the stock price might not go down too much. But all of the people they've made redundant have lost their jobs, so they won't be out spending like normal, and that's going to hurt the economy. As a result, this potentially creates a situation where the stock market might suffer, but less so than the economy. Still though, this explains part, but it doesn't explain how companies are priced higher today than they were at the start of the year. Well, the truth is that most companies in the stock market are actually down, which sounds kind of crazy when the overall stock market is up, but the truth is most are nowhere near their all-time highs, because the largest companies are up significantly, and so they are balancing out these losses. Remember, when you have the S&P 500, which represents America's 500 largest companies, the companies at the top, the Apples, the Amazons, the Facebooks, they represent much larger portions of the overall pie. So if one of these companies performs well, it can actually balance out, say, 10 companies in the middle not performing so well and losing value. And that's how you can end up in a situation where most of the companies are down, the majority of them are down, but the overall market is up. If we take a quick look at the weighting of the S&P 500 as well, I think we can clearly see why this is happening. The largest sector by far, with nearly double the value of the next largest, is information technology, or tech companies. With everything going on, tech companies have been the most unaffected of all types of companies out there. While you might not be able to go to a restaurant, you can still order from Amazon. While you maybe can't go to a meeting at work, you can download Zoom and video call people from your home. I'm not going to run you through more examples. It's not really a good use of your time, and I think we can all understand how tech companies have continued to perform well, while other companies have potentially struggled in these tough times. So if you consider the tech companies represent by far the largest portion of the market, well, now we can begin to see how they are essentially dragging up the market even as other companies have suffered. Okay, so the picture is beginning to get a bit clearer. But I mean, still, Amazon, for example, is relying on people buying stuff. While Amazon might be taking some of the purchases which would have occurred in a store otherwise, are people really buying more items overall? Are companies really willing to spend as much on advertising, say on Facebook, as they were before? Even if they are, is it really so much more that it balances out the losses from other companies? Now, this, in my opinion, and it's cool if you disagree, it's just my personal opinion, and again, I'm just sharing my own research and thoughts, but I think the single biggest factor which really explains what's going on here is that the US dollar is simply losing value. The US dollar is going down. Remember, everything is valued based on the currency. When we talk about Apple crossing a market cap of $2 billion, obviously we're talking about $2 billion. So what happens when the dollar loses value? Well, it effectively means that everything else increases in value when you compare it to the dollar price. So a stock that would have been $500, it's now worth $520. It doesn't mean that the stock actually increased in value, it simply means that the dollar lost value. I mean, when you think about it, money itself, the piece of paper, it doesn't mean anything. Its only value is what you can buy with it. If stocks have risen in dollar terms, but they are less valuable today than they were at the start of the year, compared to physical things that you can buy, like a house or your groceries, and they haven't really climbed in value at all. They've simply climbed in value compared to the dollar, which again has lost value compared to many other items. So I think all four of these factors are important. Number one, the stock market isn't really a reflection of today, it's forward looking. Number two, the Fed has printed vast sums of money. Number three, large companies are pulling up the value of the overall market, even as most companies are dropping in value. And number four, the dollar dropping in value is making it look like the stock market is rising. So let's talk about the next two questions then. When will the market crash? And what can we do to protect ourselves? Okay, so I want to be honest with you here. I made a video back in June, I believe, highlighting 4 big negative factors for the economy, which were coinciding around July 31st. And then I made the really stupid mistake of making a video and basically saying that the market could therefore crash around this date, around July 31st. And as easy as it would be for me to simply hide from this video or to take it down, I'm talking about it now because I think it's only right to be completely honest. And when I made that video, there were major reasons to think that the stock market could suffer. Whereas now when I look to the future, the only significant factor, as significant as those that I see on the horizon, is the election. And no, I'm not going to make any predictions and probably get it wrong again. What I'm going to say is that some experts are predicting a potential dip in the market in the lead up to the election and maybe afterwards based on the outcome. Some experts are predicting this, instead of a dip, it could be a full-on crash. Now, for me personally, I think it's really difficult to call, and again, I'm not even going to try. I mean, I think we can all agree that the market today is probably not where it should be based on fundamentals. I mean, again, I don't think there's many people out there who are as optimistic today about the next 12 months as they were at the start of the year, considering everything that's happened, and yet we're at all-time highs. And as a result of that, I think it does make sense that the market at some point is likely to fall in line with reality, and that maybe means a crash or a pullback does seem kind of likely. Now, when it comes to protecting yourself in case this happens, I'm going to outline a few steps that I think are key. And let me say straight away, it's not possible to time the market. Even when I made a video about the crash around July 31st, I still concluded with saying that I don't think selling shares to try to time the market is a good idea. In fact, I even did a whole video shortly afterwards running through the data and the scientific research to back this up. So if timing the market is out, what is a good plan then? Well, the first thing that every investor must do, and yet so many of us overlook, is to simply save up an emergency fund in cash, which will cover you for the next 6 to 12 months. And I know, this isn't investing per se, but the truth is, this is much more important and essential than any investment you can ever make. Once you've put this amount of cash to one side, you want to think about what to do with the rest of your cash. As Ray Dalio says, cash is usually a seductive investment because it doesn't have much volatility, but it does tax you every year. Well, over the past decade, that tax in terms of inflation has been pretty low. Now, I've talked about this quite a lot in recent videos, but I personally think that inflation is going to be on the rise soon. The Fed printed their way out of deflation, and that was a good thing. But in order to support the economy, I think they're going to keep printing money until we get to a point of having higher inflation. And as a result, the value of cash will fall in compared to the value of other investments, which we're kind of already seeing. So I think it's a good idea to be invested. I think it's an even better idea to be well diversified. Diversification means you're not putting all your eggs in one basket, so you are better protected in case one market doesn't do as well. It also means looking at investments which tend to perform well in times of inflation. Investments such as gold, silver, and a small amount of more speculative investments such as Bitcoin and Ether. Now, if you want to learn more about diversification and understand the exact step-by-step process, check out this video up here where I've broken down everything you need to know and offered real, specific examples. Remember to subscribe if you've enjoyed this video, and of course, just thank you for watching.